Good afternoon. My name is Ward Keever. I am the founder, president, and CEO of Covenant Wealth Strategies. Today is Tuesday, January 27th, 2026, and most of the people who will be viewing or listening to this have been impacted by a large winter storm. And so we are, in fact, the three of us today, myself and Michelle and Jeff Roach, are all working remotely from our home offices. Um, we are glad to have you with us, and we are especially excited to have Dr. Jeffrey Roach, who is the Chief Economist for LPL Financial. And I'd like to just share a brief introduction. Uh, Jeff is a senior member, a voting member of the Strategic and Tactical Asset Allocation Committee at LPL, where his ability to relate economic conditions to financial markets and related outcomes is highly valued. His broad experience on an institutional trading floor and in portfolio management make Jeff an engaging speaker for any audience. Prior to his current role at LPL Financial, he was a senior economist with Visa, where he focused on macroeconomic forecasting for both internal stakeholders and external global clients. Dr. Roach started his career as a trading floor economist on Bank of America's corporate trading desk and was also a portfolio manager of a five-star rated mutual fund. While on Bank of America's corporate trading desk, his group was responsible for internal economic research and was periodically sent to FOMC officials. In order to facilitate cutting-edge research, Jeff maintains frequent contact with Federal Reserve economists, Wall Street analysts, and other leading money managers from around the world. Jeff is a contributor to the financial press as well as a sought-after speaker and has presented economic research to international audiences. Jeff earned both a PhD and a MA in economics from Clemson University and a BS in mathematics from Bob Jones University, and also received a visiting research appointment at Harvard University. So Jeff's accolades are extensive. I am also very thankful to be able to tell you that Jeff is a personal friend of mine and recently was with us down in Ocean City, New Jersey, at our home in Ocean City, where he enjoyed some of my wife Debbie's hospitality. And we actually presented to our Covenant Wealth Strategies investment team remotely from our new office in Ocean City, New Jersey, and of course picked up several cans of Johnson's popcorn from the boardwalk that were carefully carried home on the airplane. I had the pleasure of knowing Jeff for several years. We have fellowship together in Barcelona, Spain, as well as several different conferences here in the U.S. Jeff is a very accomplished musician. He has played his trumpet and sang music in Notre Dame. He also led the choir in a Christmas Eve concert this past December. And he also, I just learned, was somehow persuaded into three separate polar plunges on New Year's Day with his nephews. So I'd like to meet those nephews because I think that they are apparently very, very persuasive. Just before our call started, Jeff and our own Michelle Fisher, who is also a jazz performance musician, were geeking out, if I can use that terminology, about Winston Marsalis and the Cuban and Latin influence on their favorite jazz artists as compared to New Orleans jazz. I have to say I'm not a connoisseur. I didn't realize that there was such refinement. But we are just thrilled to have Jeff with us, a fascinating individual, a tremendous speaker, and you are in for a real treat today. Jeff, I know Michelle is on mute and off camera. I will likewise do the same, but we are both here standing by should you need anything. And at the conclusion of your remarks, we will handle some Q&A, including some questions that have already come in prior to your presentation. And one of your slides will say that any and all questions can be directed to Michelle at Covenant Wealth Strategies, and she will be forwarding those to me. So without further ado, Jeff, take it away.
Well, thanks, Ward, for that very kind introduction. Yes, Wynton Marsalis actually began studying as a classical musician. I think that's why he's such a phenomenal jazz player, because of those foundations. So what a fun little conversation we had before we started. So I'm going to give you a couple hot topics where I sit as an economist looking at markets, global situation, different economies around the world, and what I think are some hot takes. Now, granted, there are 1,001 hot topics. I'm not going to cover all of them. So the value at the end, I'm not going to talk more than, say, 20 minutes at most. The value here is ask me what I didn't cover. I'll try to cover, like I said, what I think about, but there are a lot of things. So please, love Q&A. I always did this when I was teaching during my graduate school days. I had the pleasure of having a lot of Clemson football players in class, and one of the ways to keep them awake and engaged was to again offer the opportunity to ask questions. So please do, Michelle at Covenant Wealth Strategies. You see that on the screen right here. So let me begin. The theme of the talk is this policy engine, and I want to start out with the economy, and then we'll move into stocks and bonds, and we'll talk about the dollar and a little bit of gold. That's a hot take. And then, maybe during Q&A, more about global trade and tariffs and what's happening in the oil markets. So I put it like this: the more things change, the more they stay the same, meaning that as we think about 2026, even though there's a lot of interesting dynamics, I think it's going to be more of the same, like 2022 and 23 and 24 and 25. 26 is going to be a little bit softer, right? It's not going to be that massive rebound that we saw in the years immediately after COVID, but it's going to be really similar in the sense that the economy is going to grow. The blue columns right here showing quarter-on-quarter growth of the economy. The latest figure we have is this figure for the second quarter. Actually, we do have the third quarter, and it's pretty hot too. Just came out. We'll get the fourth quarter in a couple of weeks, but we're going into a little bit of a downshift in growth, but it's still positive, and it's still strong, and it's still what we call a K-type economy, a K-shaped economy. You think about the letter K. You got the upper part of the letter. You got the lower part. The upper upper portion is kind of illustrating this idea that the more wealthy households are doing fine and they're spending. And then you have those that perhaps are Gen Zs and they don't have the net wealth. They don't have home ownership yet. They're feeling some pressure. It's not just by age, but you have this bifurcation as illustrated by the K-shaped economy. We think 2026 actually is going to be pretty decent because there's going to be a couple of pops to the economy. One, from bonus depreciation, the idea that when these firms, particularly tech firms, want to put a ton of money in things that are AI related, or really any type of CapEx, that just stands for capital expenditures. It could be a big machine if you're a manufacturing plant, could be new buildings and warehousing. It could be more computers, any of those capital expenditures. Businesses can appreciate that or depreciate that on the books right away. And that can be a real stimulative impact. And then the second stimulative impact is the likelihood that tax returns will be a little bit larger than expected, and that'll provide a little bit of boost for the first half of the year. Second half of the year, again, a little bit of that deceleration. You can kind of see that going down here in 2026 by quarter. So more of the same, but a little bit softer. That's kind of where we think the economy is. And what's interesting is this shift toward just the makeup of the economy. Think of it this way, 20, 30 years ago, a large percentage of jobs were in manufacturing. Now, not so much. We're more services. We're more healthcare related. We're more financial services. Real estate picks up a lot of the economy. And what I'm showing you here in this slice of the pie is what we call intellectual property. So in recent years, that makes up about 7% of the economy. We think that that's actually going to grow. That slice of the pie is going to get a little bit bigger. And that's probably going to take from some of the numbers from exports, imports, trade. So a little bit less in trade, more in what we call intellectual property. That means software, that means research and development, that means anything related to the creation of new ideas that may not earn revenue yet, but it's expected to earn revenue in the future. So that's just going to be a more important part of how the economy operates in the next year or two or three. This is really more of a structural shift than just a cyclical one. So I think when it comes to inflation, that's kind of the biggest hot take here going on now is we're going to have inflation run a little bit hotter in the next couple of months. But when you think about some of the components of inflation, particularly rents and housing costs, even insurance prices seem to be past peak. We're starting to see a little bit of slowdown, or at least kind of the foundation for a deceleration. So the Fed likes to say, hey, in the long run, we want to target a 2% inflation rate, give or take. Sometimes it's going to run a little bit below 2%. That's what it was like pre-COVID. Post-COVID, obviously, was way above the 2% target. But the Fed's going to want to keep long-run average of 2%. We're still running too hot. That's why they're not aggressively cutting. In fact, the Fed's meeting today and tomorrow. Tomorrow at 2:30 Eastern Time, there'll be an announcement. No expectations of a Fed cut tomorrow. But there are going to be conversations about the Fed setting up the market to anticipate some cuts later this year, in the latter half of the year. And I think we're pretty comfortable with that. We think that makes sense. And you might say, well, why not earlier? Well, glad you asked. You look at this chart, and it's a pretty simple one. Blue line is an index that represents what businesses are saying about what they're paying for input costs. Okay, so Caterpillar and Boeing and Walmart and you name it. You got all these industries, and there's an index that actually tracks what they're saying about business. Often tracks pretty well with what consumers eventually feel. That's the copper line. That's CPI, Consumer Price Index. That's what is reported every month. And what the Fed tracks. They track another inflation metric as well. But what I wanted to tell you in this chart is basically saying, hey, when you think about where the pressures are, where's the most likely movement? Is it going to be up, down, or sideways? In the near term, looks like inflation's probably going to run a little bit hotter in the near term rather than a continuing of this deceleration. We think it's going to run a little hotter because of the fact that we still have a little bit of unknowns about tariff pass-throughs. So near-term pain, I think the big picture story is this. When you think about how your financial advisor works with this, you think, okay, we're not into trading headlines. We don't want to trade. We want to invest. We say, okay, there might be some near-term pain, but we think about where the latter half of the year is going into 2027. That's what really matters in terms of managing portfolios. So that's kind of the big picture of it all. And you might say, okay, well, where does it relate to you, Mr. and Mrs. Smith that live on Main Street? We talk about Wall Street all the time. What about Main Street? Well, think of it this way. And I'm showing you a chart here of the 10-year Treasury. That's the blue line. And then the orange columns is the 30-year mortgage rate. The average, this is from bankrate.com, literally. So it's public data. And you could say, okay, well, we know over the last 18 months, we've continued to see this decline, this softening in mortgage rates. We think that that's pretty good. We think that as it gets lower and lower, it's going to kind of clog up some of the gum that's in the system of the housing market. And I think that's going to help out a little bit when you think about where 2026 will go. And we think we'll continue to see a little bit of this softening in mortgage rates. We can talk about auto loans and credit card and et cetera, other consumer loans if you'd like, again, during the Q&A. But this is just from a housing standpoint. Now, granted, affordability is a big problem, particularly those that are, in their 20s, in their 30s, trying to get that first house. Unfortunately, we continue to see a much older and older age for your first time home buyer. It's really quite staggering how first-time home buyers continue to get pushed out. But that's the big picture. I want to talk about what does this mean for stocks? What does this mean for valuations and what we think is going to happen throughout 2026? And that is this. We think we've had a pretty decent last few years. Think about that low of October 2022. Things were looking pretty nasty. We thought we were going to be in recession. Markets were quite nervous, and that was why we saw a really negative sentiment. But since that bottom of October 22, things are going strong. And what's interesting, this is a chart basically just saying, well, what happens when you have 3 consecutive years of an up market? What happens in the 4th year? And there's actually several instances where the market has gone for at least 3 years. And what's interesting, going back to 49, 57, 74, I'm looking at those dates on the bottom horizontal axis, the x-axis of this chart, and it just gives you historically what's happening. So you think about the 90s. Here's the early 80s. We think the 90s is real similar. Now, they didn't have quite the stability of just kind of a market going up and to the right. We often like to say, of course, when you look at a chart, right, up and to the right, that means things are going up and capital and equity prices are appreciating. We want to just basically highlight the fact that on average, this is the far right part of the chart. On average, we've seen some really strong first year of the bull, and the second and third kind of peter out a little bit, but it's still positive. And that 4th year, on average, still see kind of a low double digits. We don't think we're going to get double digits in 2026, but we do think that things seem to look pretty good for a risk on type of portfolio, but maybe diversifying and managing too much risk at this time because we think, yes, things look okay, but things are fragile. Meaning, when you think about an economic cycle, people like to say economic cycles don't die of old age, they get assassinated, meaning there's some type of shock. So think of the shock of the pandemic in 07, 08. Think of the shock of Lehman Brothers blowing up, the banking system looking really weird. Think about, early 2000s, well, the shock of the terrorist attack, September 11th. So a lot of times there's a shock that kind of pushes things off the rails. And so that's one of the reasons why it's so important to track geopolitical risks. But at this point, you still say, okay, businesses are doing okay. They still have pretty healthy balance sheets, cash on hand. They're financing a lot of projects, not by borrowing per se, but by just the cash they have on hand. And the middle and upper income consumers are doing okay. They're continuing the spending side of things, but there certainly are pockets of weaknesses, and you want to make sure that's not going to spread. So that's the point here. Another point too is this. It's quite interesting where we sit, and this is, again, we could talk about this for a Q&A too if there's questions. Thinking about where you are in the Northeast and the importance of ports and international trade and all that. think about trade and you think about where the economy is relative to previous cycles, what's very, very interesting, and this is the chart I'm showing here, is when the Federal Reserve starts cutting interest rates, which means they're easing up on policy, and they're doing that in a period of time where there's no recession, that's often very good for risk assets, meaning equity markets are going to do pretty well. That typically is pretty good. That's this aqua teal color. So cuts meaning a cut in federal funds rate with no recession. The copper is the cuts with recession. Normally the Fed's saying, hey, we need to cut rates because the economy is falling apart. And that's normally what happens. In fact, we've had this other kind of debate a couple years ago was, when the Fed hikes rates, they often hike too much and they break something. Interestingly enough, they didn't quote unquote break anything because the economy, here's another topic maybe for Q&A, the economy is just less interest rate sensitive. Part of that is because of the demographics of the economy. So Fed was hiking intensely and nothing broke. I think the Fed can actually start easing and inflation will not accelerate for the same reason. So I'll just leave it at that. I do want to get to Mag 7 and then bonds, commodities, gold. I think I'm doing okay. I got to talk a little faster. So we talk about the S&P 500 a lot. So that's 500 stocks. Top stocks were those magnificent seven. So Meta and Google, Amazon, Nvidia, Tesla, etc. So a lot of times we started talking about, you'll see this in the headlines of the press, the S&P 493. It's basically just saying, let's take out the Mag 7, look at the 493. Earnings are still set to grow pretty well, even outside of the Mag 7. I'll just leave it at that. That's one of the reasons why we have somewhat of an optimistic view here. Midterms, interestingly enough, when we think about midterms, it's this one right here. Maybe I can circle it. Oh, that's a really fat circle. I think when you think about midterms, I think the idea is you have a lot more volatility, but it tends to be a good market during midterms too. Let's talk bonds. And then move on. So 10-year, one major chart I just want to show on this one, and that is this. You look at this bottom line, that's the Fed funds rate. The vertical y-axis, that's your 10-year. You see this relationship between the Fed funds rate and the 10-year. We think we're going to be, by the end of the year, we're going to be somewhere around here where you see a little bit of downward pressure. The 10 years I'm looking at a 423 right now. We think it's going to lower after we kind of get some of this shakeout in the very, very near term from the drama from Davos, we could say. One quick thing, and then again, if you have questions, when we think about how, where we sit as LPL research team, we look at spreads to help us identify where risks might be. Spreads just mean how much extra compensation does a more risky asset need to get to compensate them to taking on that extra risk relative to, say, like a treasury note, which is kind of a risk-free asset. So that premium on top of the risk-free is kind of saying, okay, that's what I need to get paid to put on this risk. Well, when the premium's low, that means, hey, we don't feel like we're taking on a lot of risk. That means spreads are narrow. That's what we're saying. Spreads are very low. This is what we're talking about here. Spreads for most credit markets seem very small, meaning there's not much risk here in the market. Or stress, I should say. All right, dollar. Here's just one thing on the dollar. So dollar made a lot of news even the last couple hours because it really has been plummeting. Part of it's due to some of the unusual movements in Japan. Want to highlight this. I do not think in the next generation, maybe in the next two generations, so my lifetime, kids' lifetime, that the dollar is going to be replaced as a global reserve currency. I think what we're seeing is there's a diversification. So this shaded area is telling us what is the dollar makeup of global currency reserves. So go to the right side here, and we're a little over 70% of global reserves were dollars back in 2000. Fast forward 25 years, we're down to about 58%. Yes, we're down, but when you think about what other opportunities there are, it's more of a diversification, not necessarily a move away from the US dollar. Let me talk briefly gold, and then I'll open up. So here's a hot take, and this is something that's been happening for the last couple of years. One of the reasons why gold is rallying so much is that a lot of central banks are starting to use gold as just their general put it in their portfolio. When you think about your own portfolio, you want to diversify, right? You have some bonds, some stocks, some alternative investments, etc. Well, in the same way, central banks, sovereign wealth funds, large institutions do the same thing. They say, okay, we want to hold assets for a number of reasons. And what's interesting is a lot of central banks have begun to hold more and more gold. And this is illustrated by this teal color central bank demand for gold. And you can see, you know, right into going into the pandemic. And it wasn't until about late 2022, you see that just a large demand from central banks. That's the reason why you're starting to see you've seen so much of a rally in gold prices. Well, I'm going to stop there. Like I said, there's a lot there, a lot to unpack, a lot of interesting things moving around. But I'll turn it back to you, Ward. And if there's any questions, truly, I was a teacher all through grad school. There is truly nothing, no such thing as a dumb question. So with that, back to you.
Thank you, Jeff. I appreciate your comments. Some questions that we had come in advance of your presentation. A number of questions about tariffs and how those tariffs are impacting global trade, potential destabilization through difficulty to predict the next tariff, and if tariffs are being, per se, passed through or absorbed by the consumer, and that might be what's causing inflation to run hot. So there were a couple of different things that came in, so I just kind of packaged them all there into one question for you, if you could speak to tariffs.
Yeah, I think that's a great question. So when you think about tariffs, there's a lot of interesting things to think about. You can go all the way back to the period of mercantilism. I mean, that was part of the reason why countries were using tariffs so much. They were protecting their gold. Speaking of gold, but obviously the currencies were a lot more tied to gold. So think about that mercantilism period. When you fast forward even to 21st century and the 20th century, we had tariffs for a while in this country, very, very early on, but we didn't have to raise revenue, but we didn't have income tax. So when you think about different ways of earning revenue for a country, you say, well, you don't need both. Meaning in this current system, a tariff is an extra tax that's fundamentally a headwind to the economy. Meaning we don't like that. It's not good. And there are risks to tariffs. That said, what I think tariffs can do is it can kind of force businesses to reassess how and where they're doing business and thinking about the inherent vulnerabilities in trade. I think of international trade like a marriage. When you get into a marriage, you realize you're pretty vulnerable. There are some vulnerabilities. There's gains from trade, but vulnerabilities from trade. Of course, we saw that with the pandemic. We couldn't get semiconductors. We couldn't get a lot of important things because we were relying on our foreign trading partners for really important things. I think what the tariff scare has done to businesses is said, hey, we realized we had supply chain problems in 2020, 2021. They started actually addressing that to reshoring or near-shoring, using those terms. And so, 2025 comes around. It's interesting, very interesting case study, because I think if Trump 2.0 was was really like Trump in Trump 1.0, it would have been catastrophic for the economy
Mm.
because COVID happened and businesses had already adjusted a lot and rethought a lot of these supply chain and logistics. The shock of a Trump 2.0 wasn't as bad. It was still a shock, but it wasn't as bad because businesses had already said, "Hey, we've lived through this once. We're not going to live. Shame on me if this happens again." Right? Well, tariffs are taxes. We don't like that. Like free trade, but free trade is great, assuming there's no geopolitical risk. It's like free trade is great when you can always trust your trading partner. Well, that's kind of naive. You think about where trade is, and I love watching the ports in Charleston because Charleston, South Carolina, is a pretty large port. Of course, you guys up there in the Northeast have a few large ports there. So as it relates to inflation, I know there's a lot of questions within that one question you gave me, Ward. But as it relates to inflation, what's interesting, we learned this from the Beige Book and talking to business owners. A lot of U.S. importers and businesses were actually reluctant to pass along the cost to the end consumer because they wanted to protect market share. They knew that we were in kind of an unusual environment. So tariffs so far has kind of hit margins more than it's hit the end consumer, generally speaking. Now, granted, there are a couple one-offs where you think, whoa, that price just skyrocketed of that particular item. So, yes, there are those items where this is a, we felt it right away on the shelf. But generally speaking, there's a little bit of uncertainty, and it hasn't been a huge pass through. Hence, we think some of the tariff pass through might actually show up in the early part of this year, even
Mm.
though tariffs have been a conversation for the last several quarters now.
What are your thoughts, Jeff, about the current administration and how they wield tariffs when you talk about trading partners and being reliable and that sort of thing? There's some perspective out there that the current administration's use of tariffs and threats of tariffs, and whether it's against allies like South Korea or Canada just within the last week, tariffs
Mhm.
threatened, makes us as the U.S. makes us perhaps an unreliable trading partner. Do you have any thoughts or insights on that topic?
Well, for sure, tariffs, I think, have been used as a policy tool. It truly is a threat, right? I mean, we've seen this since April 2nd. Big announcement, and then a delay in implementation or a massive adjustment to the rate. So, for example, think of it this way. I track this on a regular basis. So the average effective tariff rate, when you think about everything we import in this country, whether it's finished goods or primary goods, intermediate goods, raw materials, it's about 13% average effective tariff rate. That's not bad. 13% is not bad. Yes, it's an extra tax, but it's not crippling. So when you think about what it does, though, for business planning, obviously it's very difficult for particularly your smaller business, your smaller sized industry that is trying to manage through. Granted, the big companies, yeah, they got a ton of lobbyists. I remember, my first job at Bank of America, we had a ton of lobbyists. I was thinking, wow, this, I knew the word lobbyist. I knew that was an occupation. I didn't realize how much it played into things. Every big firm has their lobbyists to work through things. But you think about the small companies, they don't have their own lobbyists. Maybe they're part of a trade association that's like the NFIB, National Federation of Independent Business, that are trying to, argue on their behalf. But it's been very difficult for those smaller firms to plan, and that's been a challenge. So far, though, I mean, when you think about growth numbers, we have not seen that headwind to growth be that strong. it hasn't really impacted much yet.
One of the things you did not speak to in your presentation, Jeff, was employment or unemployment. We've seen unemployment move up recently. And so, if you want to speak to maybe over the last 6 to 12 months, what's happened with the unemployment rate, and then what you see going forward.
Well, that is one of the most important metrics that we track. In fact, I just wrote something and talked about this on a TV interview yesterday, and that is this. We've had a very, very unusually low unemployment rate. Say last year, labor market was tight. We're in the upper threes. That's very, very tight. In fact, Chairman Powell talked about that. There were more openings than people able to fill them. That's a tight market. Typically good for workers, right? You saw that in the last couple of years, people could jump around from one job and switch to another and get a 25% pay raise, on the spot. Starting to see just a weakening in demand for workers. Ironically, this is because of a good thing. We've actually seen productivity growth in the last couple quarters really strengthen, meaning that firms can do more with less people. Now, in the near term, that doesn't sound very good. In the long term, that's great because we know where our population is going. Right? We're becoming more and more this imbalance between people working in the labor force, those people that are in the retirement category, and of course people living longer. You have just a larger percentage of the population outside the workforce. We have to be able to do more with less people because that's the trend we're going. In the near term, though, that can be really tough. I think we're going to see an uptick in unemployment to about 4.7%, say by the summertime. We're at 4.4 now.
Mhm.
So we were in the upper threes. That's too low. You could think that's a too low of a number because there just aren't enough people that are there to fill open positions. You want something, maybe closer to the 4.5 range, maybe upper fours, because that's healthy. That allows for workers to kind of provide, fill the demand that businesses have. But at this point, it's really a low hire, low fire context. I think that's a great way to think of it. Low hire, meaning low labor demand from businesses. Low fire, meaning businesses are not really eager to shed their payrolls. They're just not very interested in adding to their payrolls.
Yeah,
Now,
it's
granted,
interesting.
yeah, it's
My
a yeah one just one last thing. I mean, it truly is impacting the lower skilled, lower, fewer experienced kind of individuals. Unfortunately, that is kind of the way it is when an economy is starting to slow. It typically hits first the people that are most vulnerable.
hmm some observations on our side. I had read an article that mentioned a statistic that you've never had a recession with unemployment below 5%. So that's something that we've been kind of keeping an eye on. And even coming out of 2022, there were many who were saying that we were in a recession or they were forecasting a recession, that sort of thing. But we saw unemployment very low. So our own perspective was, I don't think we're going to see a recession as long as unemployment stays below 5%, and that's been the case. What are your thoughts about AI, speaking about, doing more with less and talking about populations, the youth population, I forget the exact age range, but I think it's maybe 16 to 20 or 16 to 21, apparently has the highest unemployment rate of any per se age group. And we're seeing in our own per se recruiting discussions and that sort of thing through the use of AI, some of the tools that we're using here in our own company reduce the need maybe for us to hire people coming straight out of school because some of the entry level roles and responsibilities that they would have are being done by AI. So, can you speak to AI and its interaction not only with employment or unemployment, but also perhaps with that productivity number you mentioned earlier?
Right. So AI is certainly going to replace those with basic skills or no skills. the recent college grads, et cetera, that's going to be a little easier. Now, granted, it's not necessarily one for one. And it's because of the next thing that I want to say, and hopefully the audience remembers this stat, which is phenomenal. 60% of jobs today didn't exist in my grandparents' era. Let that sink in for a little bit. Meaning, if you have a dynamic labor market, enough of a freedom to kind of move from industry to industry, the liberty to be flexible, the labor force adapts.
Mhm.
It truly does adapt, even though you've had vast technological improvements since the 1940s,
Yeah,
of course.
yeah.
So that's something to think about. That stat actually that comes from MIT. There's a guy that does some really great work, David Autor, A Autor. If anybody wants to Google him, done some really neat research on that.
David Autor at MIT.
Mhm.
Fantastic. Another question that came in is the debt. So this is a topic that you didn't speak to, but the national debt, which is now, I think, north of $38 trillion dollars. What is that impact on the economy, both historically and now and in the future? And then do you think that that's having any impact on the dollar? Is that part of the price swings that we're seeing in the dollar as a currency?
Yeah, that's a good question. I don't think it's impacting the Dow. That's not the impact. I will say though that one of the things that needs to happen and where we're, at those vulnerable, fragile moments is when you continue to have shocks to the economy that you don't have a period of time where there's just some steady growth. Think about like 2002, three, and four, right? That was where we had some interesting surpluses in the federal budget. I think it was 2004, if I'm not mistaken. What that was is you had a few years where there weren't any shocks. Now, granted, '01 was the September 11th, but if you have a couple of years where there aren't shocks to the economy and the economy can grow, one of the biggest things I like to say is the best way to solve a problem is let the government get out of the way and let the private sector be the private sector, meaning let them innovate, create, be productive, produce things, and you can actually have an environment where the economy can grow even above trend, near term trend, and at the same time not be inflationary because it's very much a supply side experience. Well, what happens is if you have a strong pro growth kind of policy, that will allow tax receipts to grow fast enough, allow those receipts to to help out soften some of the debt. Now, granted, are we ever so it's going to soften the growth rate? Are we ever going to be able to you know chop into this huge boulder, this mountain of debt? Uh, I don't see how we can, but at least if we can slow down the rate of growth of it, that might be a good strategy in the near term.
I know some people view the national debt as relative to GDP, and so as GDP continues to increase, that's
Yes.
part of their justification, if you will, for why allowing the debt to increase is not necessarily a bad thing.
And
You touched
if the economy grows faster than the debt, right, then as a percent of GDP gets a little bit softer.
Although I
Yeah.
did hear that our largest single line item is currently interest on the debt. It's over $1 trillion last year was spent on interest, debt service, if you will, which is larger even than defense spending. So I did think that was an interesting statistic on the national debt that I recently came across. One other topic is just you touched on precious metals. We've certainly seen over the last couple of years, and especially in 2025, I think gold prices might have been up 70%. And some people view that as lackluster because they were invested in silver, which is up, what, 130 or 140%. So can you just speak to, and quite frankly, also, if you look at the charts on either of those, I mean, silver specifically is just seems meteoric in terms of the the way that the chart has gone off to the top there. Is there still room in the upside? Are these things per se overbought, or how do you incorporate precious metals into a portfolio?
Yeah, well, we do think that there's a little bit more upside. We're probably at the tail end. It might be a good diversifier. I think, as I mentioned, the demand from central banks have really driven gold specifically. I think silver is just kind of playing off the coat sleeves of gold. It's not necessarily an inflation hedge like you would traditionally think of commodities. Say, a decade ago, that was kind of conventional wisdom. I really think it's just raw demand, particularly from the really, really big buyers. So maybe there's a little bit more to go. So
Hmm.
even though it
Yeah, it's
seems
interesting
crazy.
just because, I mean, it's a commodity, so you can't do price to earnings, you can't do revenue growth, you can't look at the leadership team of the company or that sort of thing. So, commodities have, such as precious metals and silver being more of an industrial metal, been I think, a challenging place, per se, to invest. But certainly, as your comment, inflation has gone down from 9.1% down to currently into the upper twos. And as inflation has gone down, commodity prices and specifically gold and silver prices have gone up. So it doesn't seem to
Mhm.
be a traditional conventional relationship between inflation and those precious metals. One other question, just as we're coming to the conclusion of our time together. I liked the initial slide, Jeff, that you put up in your presentation because it reminded me of a gear board. And this is an illustration that we've been using with our clients, just talking about, when we were kids or when we had kids or now that we have grandkids, looking at the idea of a gear board, and it's a flat board that you put these gears into, and the teeth of the gears, per se, intertwine, and one of the gears has a handle, and if you turn the handle on one of the gears, all the gears on the board move. And this seems to be a tremendous illustration of what our economy, our domestic, our global economy, stocks and bonds, precious metals, everything else. And so it's interesting trying to figure out what's the gear with the handle? What's the cause that impacts all the other gears that are turning? So I didn't know if you could speak to that, and then separately, just talking about sectors within the investment markets that you feel have disproportionate opportunities and maybe should be overweighted going into
Yeah.
20.
Well, I think fundamentally the gear is our legal system, our role of property rights. You think about what does it require for a business to feel comfortable going into business? Well, they have to have an expectation that they're going to own the profits, well, and the losses for that matter. They're going to take ownership, and whatever happens, happens. They're going to reap what they sow, right? So if they sow some excellent ideas and they come out and make an excellent quality product, they're going to reap those benefits, and they don't have to be worried that anybody's going to come in and say, no, that's mine. I own the factors of production. So fundamentally, that question about the gears, what gear is the most fundamental? It's it's a country who has a protection for individual freedoms and individual property rights. I think again, that's a whole nother conversation we could have. But when you think about it, I lived in Silicon Valley for a little bit and realized the world comes here to innovate. And that's pretty incredible. That's pretty special, but there are
Yeah.
reasons for that. So that's all. We can talk a long time on that. But in terms of sectors, I think industrials very interesting to me. When you think about Caterpillar, right?
Hmm.
Caterpillar is able to benefit on some of the mining operations around the world. So the industrials, I think the healthcare sector looks really good. Not necessarily. I'm not talking about the insurers. They got hammered today.
Yeah.
I'm talking about even the brick and mortar companies that are providing residential healthcare. In fact, this is a fun fact. when the government comes up and calculates, all the economists calculate gross domestic product, GDP, they use source data. One of the things that they use for spending on healthcare, kind of the demand, consumer demand for healthcare, is revenues, particularly revenues from residential and outpatient healthcare facilities going gangbusters. Very interesting. And there's some opportunities there for the long haul. I think that's another area for opportunity.
Certainly, with the aging population, as we all are, each morning we wake up, we're another day older. So, well, Jeff, we thank you so much for your time. And I specifically appreciate our friendship and the opportunity that we get to spend time offline. I know sometimes people think this is about as interesting as watching paint dry, but you and I could literally spend hours and go into the wee hours of the morning, talking about this. So we appreciate you bringing your knowledge, your wisdom, your expertise, your experience, and speaking to our team and our clients here at Covenant Wealth Strategies. Are there any closing remarks or tidbits of wisdom you'd like to share with us before I go ahead and wrap this up?
Well, just a reminder for, end clients, don't try to game the headlines. Have a plan, develop a plan along with your financial shrink, and work the plan. And that's who we are. We're investors. We're not traders. I think that's an important distinction.
Super. Well, Jeff, thank you for that. I'd also like to thank Michelle Fisher for all of her work behind the scenes, setting up our Zoom and coordinating with Jeff and his busy schedule to bring him to our Covenant Wealth Strategies team and clients today. Again, today is Tuesday, January 27, 2026. My name is Ward Keever. Our guest has been Dr. Jeffrey Roach, Chief Economist at LPL. And we pray that you all stay safe and warm in this cold snap, this spell, this storm. Jeff, thanks so much, and have a great rest of your day.